Welcome back to the GSMC Business Podcast. I'm Farrar. Thanks for joining me. Chinese officials are expecting President Trump to announce the delay of another round of tariffs, which was due to take effect on Sunday. China wants the tariffs to be removed, but that seems unlikely as long as Trump remains president. The Chinese supply chain exodus continues. Foxconn, a major supplier to Apple, has already increased its Taiwan investments, and the South China Morning Post reported Wednesday that a large Samsung smartphone factory is leaving China, its duties bound for India and Vietnam. The knock-on effect is that 60% of the nearby businesses, the restaurants and shops, they've all closed up. It's a story familiar to the blue-collar workers of the United States over the past 40 years. That's what happens when factory jobs get moved overseas. But if the tariffs are delayed, it's possible the Chinese government could stave off more job losses, perhaps into the next calendar year, keeping Chinese investors happy, or at least not as unhappy. Back stateside, though, American consumers, the main force behind the U.S. economy, would continue paying higher prices. The latest round of tariffs would hit everything from cell phones, toys, and video game consoles to fireworks and even apparel. 70% of all shoes sold in the U.S., for example, are made in China. According to the BBC, more than 200 footwear companies, including Nike and Steve Madden, have spoken out against the plans for the tariffs, which were originally announced to be 10%, but has since been revised upward to 15%. If the tariffs are postponed, it would be the second time and could be blamed on fears that tariffs might impact the holiday shopping season. One thing's for sure, if the tariffs are postponed, they'll still be on the table to take effect sometime in the future. Asian markets seem optimistic, though. The Hang Seng Index in Hong Kong ended its two-day losing streak. After giving away 60 points, it jumped over 208 to finish just above 26,645. Overall, Asian markets were mostly higher with modest gains. The exception was the Nikkei in Tokyo, which lost just over 39 points to close at just about 23,371. That's a loss of 0.17%. Sony and Panasonic both saw losses on the day that Fed Chair Powell made his announcement. Meanwhile, Honda and Toyota saw modest gains of 0.5 and 0.3%, respectively. All right, who's hungry? How about some Chipotle? Wait. How about the Chipotle of all-day breakfast food? That's pretty much IHOP's new venture, Flipped by IHOP. It's their new fast casual spin-off. Instead of a burrito, customers will fill their pancake bowls, yes, that's a real thing, with ingredients such as bacon, eggs, sausage, and fruit. The idea is that busy folks in America's most densely populated metropolises want breakfast on the go. There will be no servers, no waitstaff, just a kiosk where you can order your food or do it assembly line style, plus the ever-popular online ordering. The first location is scheduled to open in Atlanta next April, and the company is eyeing sites in New York, Washington, D.C., Denver, Chicago, and San Francisco. IHOP is owned by Dine Brands Global, which bought Applebee's about 12 years ago. Now, some surprising news about an airline that's going to start offering its food on the ground. Over the years, low-cost airline AirAsia has built a loyal following for its in-flight cuisine, and now you can get a taste of their food at a brand-new restaurant called Santan. It opened on December 2nd with a menu created by 5 chefs and culinary arts students. Meals include popular in-flight options such as nasi lemak, satay skewers, and beef rendang, and other cuisine from and inspired by China, Vietnam, Malaysia, and the Philippines. Currently, the restaurant's only location is on the first floor of the Mid-Valley Megaball in Kuala Lumpur, but there are plans to open 100 restaurants worldwide in the next 5 years. For dessert, how about some ice cream? How about a few $1 billion of it? Nestle, which has been since 2014 the largest food company in the world, is spinning off its U.S. ice cream businesses in a deal valued at $4 billion. Back in 2016, Nestle created a joint venture with French private equity firm PAI Partners to manage the Swiss giant's ice cream business in 20 countries. If approved, the sale will happen probably in the first quarter of next year, after which time Nestle would manage its remaining ice cream businesses in Canada, Asia, and Latin America. The new venture is called Froneri, and it already has operations in the Asia-Pacific region, as well as Latin America, Europe, and Africa. Last year, Froneri did $3 billion in sales. Nestle's ice cream brands include Edy's, Häagen-Dazs, and Drumsticks. Nestle is expected to add $1.8 billion to Froneri's bottom line. And in other food/retail news, Target is going to discontinue its Archer Farms brand of in-house food products. The process started back in September when it started offering some products under the Good and Gather private label brand. Good and Gather will replace Archer Farms by the end of next year, saddening fans of clever wordplay everywhere. Archer, Target, offering some selling points not available under the old brand name, including no artificial flavors or colors, and depending on the product, Good and Gather will have organic options. Target plans to have Good and Gather including dairy, produce, ready-made pasta, and meats, according to Yahoo Finance. The new brand will take center stage in remodeled Target grocery departments despite continued complaints from Wall Street about out-of-stock products and thus missed sales. Target Corporation is the 8th largest retailer in the United States. We talked about real estate earlier in the podcast, and there's an investor-backed startup in Los Angeles that wants to change the way people buy homes. It's called FLEQ, F-L-E-Q, and its concept is pretty simple: rent-to-own housing. Basically, according to Yahoo Finance, FLEQ buys the customer's chosen house and sells it back to them in shares, piece by piece, in whatever time frame and amount the customer wants. FLEQ makes money by charging rent, and here's something probably no renter ever experiences: a decrease. The rent goes down as the customer owns more of the property. Eventually, the buyer will own 100% of the house's equity, and FLEQ will hand over the title. No down payment and no interest. Or they could just pay rent until they feel like leaving and then leave. The appeal of buying a house without a down payment is obvious, especially since, according to the National Association of Realtors, in 2019, 1/3 of first-time home buyers got help from family members to make their down payments. Back when the mortgage system was invented, the average home cost only 1.5 times the average salary, and down payment sizes have multiplied considerably since then. At the moment, FLEQ is the only alternative to a traditional mortgage, which is not technically still a mortgage. So-called contract for deed is an arrangement where the buyer pays the mortgage directly to the seller and the title is turned over once paid in full. Owner financing also offers a buyer-to-seller mortgage, which gives the title to the buyer up front. But those are still mortgages, and FLEQ's model would seem to appeal to people who want to live debt-free. FLEQ aims to be a financing option nationwide by 2021. Still to come, end-of-year bonuses and their tax implications, plus strategic charitable giving. Stick around.
Tired of searching the vast jungle of podcasts? Now listen close and hear this out. There's a podcast network that covers just about everything that you've been searching. The Golden State Media Concepts Podcast Network is here. Nothing less than a podcast bliss with endless hours of podcast coverage. From news, sports, music, fashion, cooking, entertainment, fantasy, football, and so much more. So stop lurking around and go straight out to the Golden State Media Concepts Podcast Network. Guaranteed to fill that podcast itch. Whatever it may be. Visit us at www.gsmcpodcast.com. Follow us on Facebook and Twitter, and download us on iTunes, SoundCloud, and Google Play.
Welcome back to the GSMC Business Podcast. I'm Farrar Hutkins. Thanks for joining me. You may have heard about that real estate company in Maryland that handed out $10 million in end-of-year bonuses to its employees. St. John Properties handed out red envelopes at its annual holiday party, and every one of its 198 employees got a bonus based on the number of years they'd worked at the company. The average bonus check was $50,000. The largest bonus was over $270,000. Even the newest employee, who hasn't even started yet, received $100. Of course, a bonus still counts as taxable income. If you're in line to get an end-of-year bonus, check your tax bracket for 2019 and 2020. You may want to defer some or all of that bonus to avoid being pushed into a higher tax bracket when you file your 2019 taxes. You can also see if there's an option to spread out the bonus over several pay periods. Bonuses are considered supplemental wages by the IRS, which means they're taxed differently from your regular paycheck. Your employer may withhold federal income tax at a flat 22% rate, or they may give it to you along with your salary. CNBC says that if the right amount of tax isn't withheld now, you could end up owing the IRS or receiving a smaller refund when you file your 2019 return next year. That 22% may not line up with your regular tax bracket, so you can request extra withholding to cover it or make a payment in advance to cover the gap. Deferring that bonus also gives you more time to offset it by increasing your charitable giving for the following year, or by consolidating 2 years' worth of giving into a single tax year to increase your deduction, assuming, that is, it's above the standard deduction of $12,200 for individuals and $24,400 for married couples. You can also offset the tax burden of that end-of-year bonus by putting more money into your retirement plan, thus reducing your taxable income. In 2019, you can put up to $19,000 into your 401k, unless you're 50 or older, in which case that goes up to $25,000. Next year, the deferral limit goes up to $19,500, plus an extra $6,500 catch-up for the 50 and older folks. Something to consider from both a tax and charitable standpoint is to make your philanthropic contributions using appreciated securities. If you have owned the stock for a year or more, you can do this to avoid capital gains tax, and if you're itemizing, claim a deduction on the fair market value of the stock. So if you've made some great stock picks over the years, this is a way to take care of the charity of your choice, avoid capital gains tax, and receive a deduction. You can even purchase additional shares of the gifted stock at the current price, so that they can, hopefully, enjoy that stock's growth at a higher cost basis. And don't forget donor-advised funds, some of which start as low as $5,000. If you're in a hurry, you can donate a big chunk to a donor-advised fund this year, take the deduction, and then take your time divvying up the grant money to charities. For example, you can put $20,000 into the fund this year, and then give out $5,000 per year in grants. Carla Freed at CNBC reminds us, though, that when you donate an appreciated asset, your deduction is limited to 30% of your adjusted gross income for that year. There's a 5-year carry-forward rule that allows you to keep writing off the donation in subsequent tax years. Long-term thinking? Moving money into a donor-advised fund also reduces the value of your taxable estate and entitles you to the charitable contribution deduction today. If you're 70 and a half years of age or older, you may be considering what to do with your mandatory IRA distribution. Remember, this money will be taxed. Your IRA distribution is another way to conduct your philanthropy and avoid taxes. An IRA charitable rollover is available to each owner of the IRA up to a maximum of $100,000 in 2019. As long as the money is transferred directly from the IRA to the charity of your choice, you don't have to pay taxes on that distribution. As always, consult your financial advisor or attorney for help. Let's circle back to international trade for a moment to talk about something that happened in Congress yesterday. After more than a year trying to iron out the details and address concerns over enforcement of labor standards under the proposed replacement for the North American Free Trade Agreement, aka NAFTA, enacted back in 1994, finally, House Democrats and the Trump administration have reached an agreement. It's the revised USMCA, that's United States-Mexico-Canada Agreement. Representatives from all three countries signed on to the agreement on Tuesday, and once official text is submitted from the White House, a 90-day approval window begins. You could call it NAFTA 2.0. It does make some key changes from the OG agreement. U.S. farmers will get better access to the Canadian dairy market, which I guess means they'll have to start bagging milk. Also, nearly 50% of auto parts will be required to be made by workers earning $16 an hour or better, and digital trade and intellectual property rules were updated because, the internet has changed quite a bit in the last 25 years. The House could vote to ratify the bill before the end of the year, which is something the White House and business groups have pushed for, partly because the lack of an agreement adds to the uncertainty farmers and other businesses are having to deal with because of the U.S.'s various trade wars. And speaking of Canada, the Guardian newspaper in the UK reports that the world's first fully electric commercial aircraft has taken its inaugural test flight. It happened in Vancouver, British Columbia, and it lasted for less than 15 minutes. The company is Magnex, an engineering firm in Australia. Magnex designed the plane's motor and worked with Harbour Air to develop the plane. Harbour Air takes 500,000 passengers every year from Vancouver to the Whistler Ski Resort and nearby islands and coastal communities. The experimental aircraft was actually a 62-year-old de Havilland Beaver seaplane retrofitted with a 750-horsepower electric motor. It was piloted by Harbour Air's founder and CEO, Greg McDougall, who said the motor was so strong that he had to back off the power a little bit. He also said that his goal is to electrify his company's entire fleet. That's more than 40 seaplanes. And since the craft is still in the experimental stage, the project will have to wait for more than 2 years, while safety and reliability tests are done, as well as having the electric motor certified and approved by regulators. In other news of flight, a U.S. House committee on Wednesday released documents showing that the Federal Aviation Administration predicted that Boeing's 737 MAX jet airplane would potentially crash if certain changes were not made. After the first crash last year, the FAA made its report, but the plane was allowed to keep flying. It wasn't until the second crash in March that the 737 MAX was grounded. The two crashes resulted in the deaths of 346 passengers and crew. FAA Administrator Stephen Dixon says the planes won't be allowed to fly again until sometime next year. USA Today quotes a former manager at Boeing who says the company ignored in-house warnings about the safety and quality of the 737 MAX. Boeing says updated pilot training requirements will go into effect next month, but airlines including United and Southwest don't have any plans to fly the 737 MAX until March. That's assuming the FAA gives approval by then. In the meantime, Southwest has reached an agreement for a payout from Boeing to compensate for losses and says it will share the $125 million payout with its employees. The payout's the result of a lawsuit brought by Southwest's pilots union in October, claiming that grounding the planes cost over $100 million in revenue. 737 MAX planes have now been grounded for 10 months. Coming up, new kids on the EV block, and Toys R Us is back, this time with more cameras. That's coming up right after this.